All right, welcome back, everybody. This is the final formal discussion and presentation for the evening. As a heads up, as I mentioned earlier, definitely stick around. We're having a happy hour that's hosted by a award-winning sommelier, Paul Greco, right after this, so you don't want to miss it. This session is entitled The Real Deal with Digital Assets. If you've joined us for the earlier part of the afternoon, in each and every session, you've definitely heard mention of digital assets, and the question has come up, how does this fit into the whole realm of global payments? Well, as luck would have it, we have a panel who's going to help us address that very question. So with that, I'd like to introduce our moderator, Brian Patrick Iha. Brian Patrick's a technology journalist and author of the book, How Money Got Free, Bitcoin and the Fight for the Future of Finance. Brian and panel, I'll let you take it away.
Thank you. Well, it occurs to me the title of this panel sounds a bit like a bad stand-up joke. What's the deal with digital assets? Well, the first digital asset we know was Bitcoin. And I remember back in 2011 or 2012, the early days when I first started writing about this stuff, people really weren't sure how to classify Bitcoin. Was it a currency? Was it a commodity? Was it a security? Some people suggested it might be best thought of as a collectible, like baseball trading cards, or maybe it was just data, pure information. Well, today, despite rulings by the IRS, the Commodity Futures Trading Commission, and others, there's still very much a kind of square peg in the round hole quality to the way we talk and think about Bitcoin, and much more so the more exotic digital assets that have been created in the past few years. And yet, somehow, that hasn't stopped the explosion of interest in this space and the explosion of enthusiasm and investing activity. The total market cap, the value of all these assets, has ballooned to more than $170 billion, with daily trading volumes between $2 billion and $7 billion. There are now more cryptocurrency users worldwide, or the number of cryptocurrency users worldwide, I should say, according to Cambridge University, now rivals the population of small countries. And many of these digital assets they have unique characteristics which make them suited for use cases and to solve problems for which there were no easy solutions before. So on this panel, we're going to kind of discuss the different use cases, how the ecosystem is evolving, how regulators should respond, and what's coming next. And I'd like to thank the panelists for being here today. When I ask kind of the first question, I've asked them to sort of fold their own introductions into their answer to my first question, because I think it will, explaining who they are and what they do will explain kind of what their vision is and the angle the angle from which they're looking at these digital assets. So the question I'd like to open up to the panel is, what are the most promising use cases that you see for digital assets today?
Hey everyone, my name is Marwan Forzli. I run Veeam. We do cross-border business-to-business payments. We're a third-generation product, third being a system where the businesses, both the payer and the receiver, are on the platform, which makes it really simple for the businesses to pay the other side. It's a very simple construction where the paying business, you log in, you provide the email address of the recipient, the amount of money you owe, and that's it. Money goes to the receiver end. All this is built on an environment called multi-rail, which is essentially a payment router that routes payments based on whatever the most efficient rail to move that money. We have existing mechanisms like traditional ways to move money, Treasury and SWIFT. We also have the more advanced rails, which is blockchain-based and variations on blockchain. So we view the market to evolve into a model where the payments are going to be very simple to work with, in particular cross-border payments, and the routing behind the scenes is going to be a lot more elegant and efficient that takes the needs of the customer and selects the rail that's best suited for that transaction. That's how we view the market evolving over time.
Yeah.
I'm Patrick Griffin. I run corporate development and business development, as well as what is becoming an emerging capital markets group around a digital currency called XRP for Ripple, and Ripple hosts conferences. We take the view of digital currencies really having a fairly isolated and restricted use case today. I think the first part of that, to answer that question about what is a use case for digital currencies, really is a question of time horizon. There are discussions about the use of digital currencies that I would say are way out into the future. Machines paying machines and sort of this use cases that feel very far away from where we are today. What is commercial and applicable today, I think, is a use case that largely is around treasury, cash management, and liquidity. Digital currencies, I think, are a new shiny tool in any treasurer's toolkit. I don't think it's a replacement for the way in which money moves around the world, but I certainly think it's a very exciting augmentation for the movement of money in the back office.
My name is Oliver Bussmann. I'm founder and managing director of Bussmann Advisory, in the business over 30 years, former CIO of UBS and SAP, helping enterprises, banks, tech firms, and startup to stay ahead of the digital disruption curve. And looking at, I agree with you, Patrick. I think the number one use case is in the global payment, cash management arena, because usually that's the area that is getting disrupted because there's huge profit pools. There's complexity from a customer experience perspective. It takes multiple days. There's a risk. There's uncertainty on there. And I've been through this the last 12 months with one of your clients, one of the leading banks in Turkey, Akbank, and one of the project manager, business manager is here. And that was a fun experience because if you look at the potential, the corporate clients are complaining about multiple days for sending money across. Costs an average $30 to $50. There's an error rate, sometimes 10-20%. And that's a trigger point also for that discussion with that bank to say, we have two options. One is a second mover, hope to watch and see if what's going on in their local country, or being a first mover, like Akbank saying, the price will come down. It will be new services coming up, and we want to be the first mover in enabling that. And for me, the experience is also coming from a large corporation like UBS, with the business and the executive team, the board fully behind that. That experience can be shortened to 6 months. Usually, I've been through this in a large bank. It takes almost a year or more of going through risk, compliance, etc. So you need a guided environment. So we did from idea to proof of concept production 6 months. And the important is you build a learning curve, how to tackle the regulatory, the legal, the security issues. You understand what are skills and capability required. And I think there's huge more potential to get even increased volume. You have more opportunity to be maybe a liquidity pool provider. So there are a new market infrastructure building up. And looking at all the use cases in the financial services industry, and we're talking about $100 billion plus just efficiency play. The global payment is a $50-60 million price tag. So that's the reason why I'm not surprised that we are talking about first global payment. The second area that now is coming up is more in the supply chain trade finance area with another potential 50 million plus efficiency gains. And so that's something that I believe. And there's much more other use cases in the pipeline because we are talking about different business models, different market infrastructure over time. But I think from a juicy perspective, that's the biggest one.
Well, Patrick, you kind of suggested that maybe, at least in their current state, digital assets are not suitable to be a complete replacement for everything we have today, but they're an augmentation of, is the word you used. And when using digital assets to make international payments, what are the benefits that are provided for the financial institutions as well as the originators and beneficiaries of payments?
Well, I think it's important to maybe put some definition around what is a digital currency.
Well, I mean, or we can talk more broadly the kind of the space of digital assets, but.
So, well, let me first maybe put my stamp on what I think is the defining sort of principles of what a digital currency is. A digital currency is an asset that has no counterparty, that resides on a blockchain, and trades like a commodity. I think those are very important aspects to separating, say, a digital asset from a token or a liability or really any other sort of electronic form of money, the difference between a token and an asset. This explicit characteristic of not having a counterparty is really the underlying principle. The only way you can create a digital asset without a central counterparty is with a blockchain. The idea of a database that has no central operator, it's instead operated by a whole network of servers and validators all over the world. This might be controversial, but I would even go so far as to say, outside of digital assets, we would probably take the view that blockchains have a fairly limited role to play. That really their principal value is in administering, clearing, and tracking digital assets. Now, to answer your first question about, or your question about where do we see the value in the augmentation of sort of treasury tools, it's not a replacement. I think that when you look at most treasury operations, so for example, BAML processing transactions with DB, those are very optimized corridors where you have, a high percentage, probably north of 99%, where there's netting, transactions are very efficient. However, when you go into more exotic currencies where liquidity is constrained for a whole host of reasons, having the ability to move in and out of that market on an on-demand basis and pick up liquidity that is made available through competitive exchanges where market makers, hedge funds, trading firms, retail speculators are providing spot pricing against local currency is a very attractive tool to very quickly move in and out of these markets without having to go through the more traditional rigmarole of pre-funding an account, opening up credit lines, opening up bank accounts. So it's not a replacement, as I said before. It's really more of a new application, a new tool that treasurers can use. And in some cases, that might be, I think in the earliest sort of rollout of this, it might just be a treasurer has a funding a shortfall overnight. So they're able to, in real time, transmit a digital currency from an exchange in one country, and 3 seconds later have that digital currency arrive at an exchange in another country, lift a spot trade, and deliver Kenyan shilling, Indian rupee, Philippine peso, whatever the case may be.
So
I knew it was going to be controversial.
Yeah, no, that's fun. That's I believe this is groundbreaking because it's not only just for digital currency. Because I think what we're moving into an edge computing that the combination of the Internet of Things and the blockchain and smart contracts is only possible in that combination perspective because the volume is etc. And coming out of one of the biggest ecosystem in cryptocurrency and blockchain is Crypto Valley, which is south of Zurich, with over almost $800 million raised in capital in the last 6 months, and there are another 70 fundraising token-generated events in the pipeline. That's for me a way that our business model is in the middle of a big change. Now that in the past, if you're a startup, you have to raise every year going through the VC business to get your 5-10 million. And now there's a way that you get access to a global pool of capital in a very efficient way. And I see not only early startup going after that, also to establish companies that already raised over the last 5 years 30-40 million to go look into that. Because they're saying, the CEO is saying to me, Oliver, I cannot afford to spend 50% of my time to talk to VCs, find a deal, find the right partner, talk about what's the right new share class to push back on getting more influence from those kind of VCs. I think that's a new way of, I would say it's kind of new way of IPO coming up. And for me, is that happened over 6 to 8 months. So the tipping point, I would say, can happen sometimes faster than we think in certain selective cases, because if the value proposition there, and that also applies for your business, if you reach a critical mass of banks, volume, then it's like snowball effect. But what I'm saying is, what I see, it's not only that it's used for a cryptocurrency or for raising security or funding, it's also utility. Because it's important that you introduce a token to get paid for a service, or you pay somebody for services, and that value also goes up depending on demand. So the consumer is not only has access to services, it's becoming also the shared contribution of success is part of that. So the discussion that I have now in the community with startups and saying, how can I increase the adoption of my services? What's the win-win situation for me as a provider and the customer? And I think the whole token topic can drive adoption. And so what I'm saying is, I think we have to think about that, is what kind of role a token can play from a utility, funding, commodity, etc. So I believe this will not go away. The regulators will find a way. They have to find a way to manage this, and we in Crypto Valley, we put frameworks out there how to classify, how to regulate this. But
Oliver, if I can come back to payments for a second, I wanted to say, Veeam, I think you can probably best answer the second part of the question I'd asked Patrick, which is, what are the benefits for the originators and the beneficiaries of these payments? Because you're already using, these digital assets today at Veeam to make these payments. And then also, given that fintechs like yours are doing this, how soon do you think it might be before banks start holding and using digital assets themselves for payments or other purposes?
Yeah, I just want to augment what Patrick said. We've been actually doing transactions on crypto and blockchain since 2014, so it's been a while. We push quite a bit of volume in a number of corridors. We find the environment is very useful in markets like Philippines and India, and places where they're not necessarily G10 currencies, but everywhere else. It's been actually a wonderful environment to work with. I view the blockchain and crypto in general bringing a number of things together. One is on-demand liquidity, so you don't have to have your own bank accounts and balances and administer all that. The second part, it's a glue. Think of it like a way to tie up a whole bunch of local domestic payment systems together, which is typically have been historically done through correspondent banking systems. Think of that as a model that is going to evolve, where at the center of it are all the digital assets, and the peripheries are domestic payment systems, and that market is the glue that connects it all together. So that essentially brings a number of benefits to the user. One, it's better transparency, superior tracking compared to SWIFT or other environments, real time. And one of the things that's really interesting is the ability to outsource payment processing to the edge of the network. So you're essentially handing off messages to a partner that executes the payment domestically on the ground. And that model is a really simple model to work with. So you end up building a whole bunch of applications on top of that infrastructure that becomes a lot easier to work with compared to traditional systems. Does that answer it?
No, absolutely. Well, how do you think regulators should be responding to digital assets? And are there certain parts of the world, I think of Singapore, I think of Switzerland, are there certain parts of the world where the regulators are taking a more progressive approach that you think other jurisdictions can learn from?
Well, so for our case, we actually waited for regulators to have a point of view in the US market. The only one that came forward is actually New York with the BitLicense program. We bypassed all that and went for a money service business. So we were fully regulated in the US market, state by state. We actually think that one of the issues with the market is regulation. Things that are not regulated are not scalable systems. They need to be regulated for it to scale. So we welcome, in general, any environment where there's been more regulation. So that's my view on the U.S. market. You guys might have other views on different markets.
Go ahead. It's all about how you define the security, and this really varies by jurisdiction. And And the Swiss regulator saying, we have defined rules for how security is defined, and everybody has to follow that from a KYC, AML perspective, documentation, and that's the way also I see is there has to be clear guidance on what kind of tokens are out there and how they should be regulated, because the security part is easy to do. The rest, the utility token, for example, is not. But the position that I'm taking on is it needs regulation, but it has to be, we have to move away from this black and white. Black meaning shutting down this doesn't help. White is wide open. And finding the balance to protect the investors, and that's important because this is a connected business, versus then also allowing innovation. Because again, these are new way of doing business, and the volume we see in the payment business is growing up. And so the regulator itself plays an important role to develop that business or not. And I think this is a competition of geographies or locations, and finding that right balance is important to attract resources, capital, knowledge, or you are limited from a future growth perspective.
So maybe setting aside tokens and just looking at digital assets. So tokens, the distinction being, there are these things called tokens that are issued by certain counterparties, companies, people, entrepreneurs, and they are issuing these tokens in the world under what's called an initial coin offering, an ICO. And they're raising massive amounts of money on the back of these tokens. And all it is really a number that resides on a spreadsheet. And it has properties of a digital asset, but the key thing is that they're being issued by a person at the end of the day. I think the regulatory constructs and the future of ICOs is super early, but I think that there's probably a very, very thin sliver that is viable. But for the vast majority of these tokens that are being created, they are being created without a company that doesn't have IP, that are being launched on the back of like a white paper. So this would be the equivalent of me launching, selling you airline points without having any airplanes. And that's exactly what's happening. And people are raising hundreds of millions of dollars on the backs of these with the promise that they're going to build a business. Now, there are some exceptions, unquestionably. But I think from a regulatory perspective, the concern is not so much that people are going to lose their money. Well, that is a huge concern. The secondary effect here is that this capital is being raised outside of any existing regulatory framework. And I think these entrepreneurs are going to open themselves up to years of class action litigation because they are not adhering to any existing established framework, which, to Oliver's point, there might be opportunity for policy and regulations to catch up. But in a lot of ways, this feels very much like these tokens feel very much like a security.
I think this will happen because I think that what I said, we are moving to more kind of IPO-like environment, but more streamlined, more efficient. Because exactly what you said, it has to be transparent. Looking at the white papers from how you document your business plan from a KYC, AML perspective. I think this will happen. It has to happen because again, it's still in a very efficient way to issue virtual stocks at the end. And there's a whole new business with legal, tax, accounting, smart contract development building up around that. So I believe that it has to oversight, has to be regulated, but itself to do this going forward could be one of the leading business models. On the other side, let me comment also on the global payment perspective, and we went through this also with the implementation that I've been through. I think it's important to know that you think the whole Ripple implementation could be also issued or hit certain regulatory issues. My experience is because it's just a transport layer, no visibility into the content of the transaction, and then educating the regulator, what's behind that. That shut down a lot of discussion. Do you need an e-money license in certain countries, etc.? So it needs education, going through the learning curve with the regulator, because they have to understand what's the real impact and how should this be managed.
Could I maybe make one other comment around just digital assets in particular, having spent some time on the token side of things? So again, digital assets.
By the way, I mean, there is some confusion on terms here because I've used the term digital assets and I've heard it used to encompass digital currencies and blockchain tokens, which sort of ride on top of an existing blockchain of a digital currency like Ethereum usually. You're kind of using digital assets just to mean digital currencies. There's already a good term for, so.
I'm just carving out what ultimately are also just balances, but the key thing about these balances is that they're immutable. They can't be just issued. No more can be issued. The supply and demand aspects, well, at least the supply side, exactly deterministic, as opposed to tokens, which are just issued. Anybody can issue a token. Anybody can issue a liability. What's attractive about them is that as they move from point A asset. But looking at the movement of digital assets and integration of these tools into treasury operations, some of the bigger, there are maybe a little bit farther out on the horizon, but some of the makers face and banks are facing implementing them. Digital assets are part of this. Just to give an example, if you look at some of the interdependent credit risk, systemic risk to the bank, effectively that plays out accounts and Vostra accounts and independent credit risk presented within. To transfer digital currencies and fund your transactions on a real-time basis frees up the need to lay out capital to counterparties while retaining the ability to service payments on a real-time basis globally and anywhere. Now, it's farther out there, and I will say that I don't know that banks are the first ones that are going to run with digital currencies. And what we are seeing, what we've just recently announced last week, are payment networks. Companies like Veeam, we recently announced a company called Qualix, who are explicitly in the business of payments. They're not doing mortgages and lending, they're just doing payments. And these guys are looking for an advantage. They're cash strapped. Any dollar that they can free up and redeploy into their marketing budget or whatever the case may be is incredibly valuable to them. And so they're looking at these flows and saying, hey, I have $1 billion tied up in my treasury operation to get into Mexico. If I could free up that capital and streamline my payments through a digital currency, my IT costs come down, my operational overhead comes down, and my working capital is much more optimized.
I mean, maybe we could talk a little bit, I'm sure some in the audience are familiar, but maybe we could talk a little bit about how we've come to be where we are today in terms of how the existing payments networks have evolved, because it's interesting to think about as payments networks like Veeam and as financial institutions begin to adopt digital assets for international payments, who or what are they really disrupting?
So I'll tell you, I'm disrupting a lousy experience when you move money on Bankwire. That's basically it. If you think of the user when you're moving money around the world, think of yourself when you're buying coffee in the morning. Do you think of payment? It's like the last thing on your mind. Do you think of emails and calendars, everything else in life? Payments is not something you think about. When you go to move money on Bankwire to pick a country, it's the opposite of that experience. You have to actually really think about your day because you have this wire phone that you have to fill, there's fees you have to pay, you got to figure out cutoff times, and after you send the money, you don't actually know what happens to your money. You got to wait till the receiver to tell you, hey, I received your money. We're like in 2017 where you can track your status on Air Miles, you can track your shipments on FedEx, you can track your pizza delivery, but for some reason you can't track your Bankwire and you're sending a lot of money on that instrument. And so fundamentally what we're disrupting is that experience. The tools themselves to enable that disruption, what the digital assets bring to the table is real-time capabilities, is tracking, superior tracking compared to existing instruments, and the ability to operate on a simple environment compared to other models. So that's how I view this. We're not really religious about this, like we don't really care about, we are doing blockchain or digital assets and therefore we should stick to that. We actually operate on a model where it's a router. You need to move money. We pick whatever is the time that's required to move the money, and we figure out what's the right instrument for that particular transaction. In some cases, digital assets shine and make existing instruments look like really old. In some cases, they're not, the environment is just not ready yet, and we find the existing instruments, for the time being, are good enough to work with. But like it's a router that optimizes based on what the user want. That's how we view the technology.
I mean, our diagnosis of why you haven't yet migrated all of your flows over to digital currencies is just a question of liquidity.
And timing.
The market is just not quite there yet for massive institutional adoption of digital currencies. I mean, just to put some numbers on it, so this time last year, in the total of all digital currencies traded in the world, we saw about $30 billion worth of trades happen collectively in aggregate. Today, the same time the following year, we're at north of $530 billion of traded against digital currencies. Not quite yet at capital markets levels where you're talking trillions, but the curve and the growth curve is coming. To answer your question about disruption, I mean, I think this is, if you're at Citibank or JP Morgan, maybe earmuffs, but I think for sure those are the, that's the model that this challenges. Citibank and JP Morgan and these large global money center banks have done a very good job of aggregating capital and laying out that capital in accounts all over the world. And they act as a central sort of nexus between all the payment flows. And there's this enormous amount of efficiencies baked within that. And if you are a customer of Citibank, Citibank knows that they can charge you right up to the switching cost. And they will charge you that on a margin basis. When you look at the flows represented by digital currencies, in effect, it's saying there's still liquidity. It's all over the world. But it's in these exchanges where you have hedge funds, trading firms, market makers, corporates, banks, all actively competing in real-time environments for these trade flows, for these payment flows, and having the ability to send every payment through these competitive marketplaces ultimately gets you the same reach that you would get with, for example, a Citibank, but every transaction is competed for. You're operating all the way down to the margin. So by the way,
yeah,
way out there.
But I think it's important is that I think we mentioned certain benefits. I think we are moving, outside financial services. If you look in certain industries, it's all about real-time execution, especially in the consumer side. That means you as a bank, as a transaction bank, you have to be in that capability, also from a legacy perspective, to handle that in real time. So real time going forward has to be a must-do. Number two is because there will be new ecosystem coming up that you are able to integrate from a network perspective. So integration of financial services embedded in other areas like in the mobility space, B2B, B2C places. Now there are new ecosystem coming up the next 10 years that will generate around about $190 trillion according to the World Bank. That requires you have to be able to interconnect and do this in real time. So what we are doing right now is preparing the banks to be part of that going forward, because it's significant business out there. Plus, I would say we are going to a fundamental structural change. Again, using the price of the unit cost coming down from $50 to $30 to $1 or even more, that is a significant reduction in workforce. So we should not underestimate that. Number two is I know that the institutional, the corporate clients love the reduced operational risk to move big amount of money in real time with an almost zero error rate. Because today you have still 10+%. So what I'm saying is this trend, we cannot stop. I think to get ready to prepare yourself for the changes, real-time transparency, able to integrate in other value chains is a must-do from a readiness and preparation. But I have to say, with the current legacy environment, that needs time, needs understanding how the business will evolve, business and technical expertise. And if you try to think about, okay, the volume is low, this will not hit me, I'll come back in 5 years. I think there will be disappointment because those tipping points in selective use case that we already talked about can happen in a short period of time.
Yep.
So I think the payment is the first case. No, I know you have already significant volume on RippleNet. If you get to 10-15% volume, then this will be a snowball effect, and nobody can, and the established networks will have a hard time to survive.
Yeah, I like couching it in terms of preparedness.
Yeah.
In a lot of, I mean, this is I'm a Ripple person, so I'm talking my own book a little bit, but that's our whole strategy. We are rolling out APIs that allow for banks to process payments using a much more robust infrastructure for automation. That is a prerequisite if you want to talk about settling transactions through digital currencies at T+0. And that's going to take some time for the banking world to be able to build that infrastructure. That's our company mission. We're set out to do that. But by the way, what I would say in the meantime, there are payment companies, and I see some out there in the audience, that are moving ahead with this. They aren't weighed down by a legacy infrastructure. They can move quickly.
Yeah, absolutely.
And I think you're going to see, companies like Alipay and Cambridge and Earthport out there with digital currencies integrated into their treasury operation, and they're going to be competing for the corporate flows that banks have traditionally dominated.
Exactly, that was one message. I think you have to put an effort in there right now because the non-banks, they're going after. Alipay announced last week they put $15 billion in R&D, blockchain, AI, etc., into their technology business perspective. I think you have to prepare yourself for that and do that. And from that perspective, I would say the non-banks are the threats. Because they don't have that legacy environment. They have a different speed and agility and try to solve problems from that perspective. So it's an opportunity not only that you have to play from an efficiency point of view, because I believe that because the retail capability and the integration will generate new products, a lot of new blue oceans that you need to understand what kind of service is coming out if we don't start now. That's my learning. And I would say we should not underestimate from a banking perspective the pressure of the corporate clients to want to see that change. And my experiences, not in the payment, but in the bond area, that those bond use cases were already up and running 3 years ago, and the banks decided not to do that. Now the corporate clients, like a Daimler, are now issuing bonds on their ledger. So you have two choices. You try to be in the driver's seat and work with your clients, or especially in the peer-to-peer environment, they have other choices to teaming with non-banks. So it's an opportunity, and on the other side there are multiple threats.
I would just add to that. I classify the banks into three segments, three categories. There's banks that are curious and absorbing whatever they can about this environment and learning about it. There's ones that are like doing pilots, and they're trying to figure out how do I use this new technology. And there's a third group, which is probably the minority, which is more proactive and have a very specific point of view on how they're going to use this technology. So, but the market is evolving quite a bit. I mean, 2 years ago, we would call the bank and we would be like outlier, like very. Now everybody's talking about this. So the market has changed quite a bit just in the past 2 years.
Right. But in terms of preparing the ground, as you were saying, for financial institutions to really get involved in this stuff and for the whole ecosystem to change, Veeam is using digital assets today in production for real customers. But when banks think about doing this, especially that first group you mentioned that are kind of dragging their feet, or at least moving more slowly toward adoption, I think the three biggest questions they have usually are, what are my regulators going to say about this? How are my accounting policies going to change? And then how does my risk change? Can you talk a little bit about how you at Veeam answered those questions?
Just also for disclosure, I have a bunch of bank investors, despite the fact I keep telling them, like, hey, what you guys do on Bankwire doesn't make any sense. They also invested because they see this as next generation products. So specific to these questions, because we're regulated, that helps because there's monitoring and supervision gives them comfort in the operations of the business. We also are not taking any digital assets as a form of payment. We only use digital currencies as a transmission. So the whole environment is based on fiat to fiat. The currencies are transmission only. We don't take any form of digital currency as a way to pay.
You don't hold it on your balance sheet?
No, we don't. We're not long on any of the currencies. We don't hold them. It's just a company policy. We use them purely for transmission, and we go in and out of them real time as quick as we can, like as quick as a machine can, to get in and out of the environment. The other thing that's important is giving them access to monitoring so that they can see the transactions real time. That gives them comfort in the operations. We give them audit rights, so whenever they want to show up and look at what's going on, they can do that. So all this environment is really prepping them to understand how this works. One last thing I'd say, because we have a concept called multi-rail, which is the ability to use multiple technologies to move money, if for any of the banks, they really are not going to be able to take any of the new rails as a method of moving money, it's really a configuration. We turn that off, and basically for any payments originating from that bank, money will not go on that rail until they're comfortable. So there's quite a bit of risk management and compliance procedures built into this to give them comfort.
And why do you think that your bank investors have not kind of started moving in this direction more themselves? They've invested in you because they see what you're doing as kind of futuristic, next generation, but are there still risk concerns that they have, or something else that stopped them, just legacy infrastructure maybe?
I mean, I think we all underestimate the amount of legacy that happens at the bank and how it takes time even for pilots, it just takes time to get integrated into their environment. I mean, they're dealing with a lot of money, and there's a lot of checks and balances, and so nothing happens overnight. But they're all moving in the right direction. Yeah. That's all I can say.
Sure.
But it's definitely different than the environment we had before in the previous years.
Sure. Well, we've got just under 19 minutes left. This is a topic that tends to inspire a lot of audience questions, so I'd like to open it up to Q&A if anyone has a question they'd like to ask the panelists. Anyone have a question? Right there.
I've been more concerned about the regulators, what they're thinking.
Oh, wait.
Oh, sorry. Thank you. I've been quite concerned about convincing the regulators that the in and out method, as you explained so eloquently a moment ago, is fine. What do you tell the regulators when they talk to you that you're not holding XRP or any digital asset, but you're using it as an in and out transmission only?
I mean, it definitely requires explanation. It's not like you fill the application and off you go. There is, I mean, so we're licensed, we're a money service business. As part of that process, we have to talk to the regulator, explain to them what we do. And when we tell them that the policy is, and it's in writing, that, hey, we're not holding, we're not long, we're in and out, and you give them an environment where they can check that, they seem to be okay with that approach so far. But it does require explanation.
Yeah, I think what is at the heart of that is that digital currencies have their origin in retail. And digital assets were, if you think back 5 years ago, 7 years ago, the promise was replace credit cards, replace your bank, use digital currencies. That has been an abysmal failure. Retail adoption of digital assets it's nowhere. And in fact, just about every payments company that went out to build a retail footprint, whether it be acquiring or on the the card, the format side on the retail, they've all pivoted. They're all either exchanges or they're vendors selling software. Nobody has really doubled down on the merchant acquiring story. So I think as a consequence of that, regulators rightly are spooked by digital currencies which fall outside of traditional means for tracking, compliance, and all sorts of regulatory issues. But I think that what that speaks largely to is digital assets have a massive story in enterprise. And I think it's still early, but I think as regulators start to understand that, that's certainly changing.
But I think certain regulators have a more an open mindset to that. If you look at the Singapore regulator, they are just now going into interbank payment based on an issue token to streamline the whole payment process between the banks in Singapore. So they're looking at certain things. The same also the Swiss and the UK regulator. They have sandbox environment and they want to see those kind of use cases, so that they're going through these experiences and understand what are the limits from a technical and also from a business perspective. So I would say we are not at the end of the discussion. I think the regulators are coming. I get a lot of requests from those regulators saying, do you have any frameworks how to classify those tokens, how those assets has to be classified, how they should be regulated, what are the options, etc. So there is an active discussion between the central banks and the regulators how to tackle that. And they try to learn from each other. But I would say, I agree with you, we are not at the end of the discussion. This will evolve. We're going through learning curves. There will be accidents, the incidents, or the blow-ups, etc. Because the technology is not. We are going through maturity level. And but I think certain regulators see this as an opportunity to change their marketplace. And these are the 3-4 regulators out there that try to be active and involved in those discussions.
Any other questions? Yep. Right over here. Oh, shout. No. Oh, you got one. Here.
So when it comes to cryptocurrencies that operate on an open permissionless ledger like Bitcoin, one of the big things that prevents people from trading it in sort of regulated financial institutions is kind of KYC, AML. As soon as they touch that blockchain, their compliance department will go crazy on them. So do you see there's any way or any structure that a cryptocurrency that's based on an open ledger could ever be traded or used by kind of mainstream financial services firms? Or does it always have to be a permissioned, closed ledger?
So it's a great question. So that's part of the reason why we only do fiat to fiat, because where the money originates comes from a bank, it finishes at a bank, so the bank is doing KYC on both ends, and we're repeating KYC again. So there's quite a bit of controls that happen along the way. One of the challenges has been trying to take any form of, like Bitcoin or any other currencies directly as a form of payment, because of the, you don't know where the transaction came from. And so in principle, it's anywhere you buy Bitcoin these days, there's quite a bit of KYC actually going on to buy that Bitcoin. So it's actually tighter than what everybody thinks. And if you're a hacker, you actually can probably hack a lot on cash and prepaid card more. It's better return on your time probably than trying to figure out how to do it on Bitcoin or any other instrument. But having said that, because there's no clear or a clean way of actually doing KYC on a Bitcoin transaction as a source of payment, that's partly why we only do fiat to fiat and use the asset as a form of exchange only.
I think it's a good point, because I think also in a fiat environment there is no 100% guarantee, no? Because you have KYC activities that are rules based, and rules are not static. It has to be dynamic, and so it's not a 100% guarantee that if you go through those KYC onboarding procedure that everything is clean, no? And so I agree. This is for the whole crypto assets. The whole KYC process is the critical part, because I see that banks are now open to take that money if there's if there's the regulator saying this is a proven process from a documentation, from a background check, etc., I see there is a change going on. But I think the industry has to tackle that, how this KYC is getting more mature, and also with AI technology better to handle the volume and going forward.
So I think these are all great points that highlight why digital assets are not well suited for retail use cases. All of these issues around KYC, AML, knowing where the source of funds is coming from, are only applicable when the transaction is originating from a user to an institution or vice versa. But when you're talking about digital currencies or digital assets moving between regulated exchanges, the KYC AML bar is much, much lower. It's not moving between retail participants. It's going from one regulated licensed entity to another. You can productize that. It's handling corporate or enterprise flows. It's not a retail product. I think that is the key. I could not agree more that from a retail perspective, this is extremely challenging. Your comment about Bitcoin, I think, raises a different issue or a different question around the nuances, and maybe it's for a topic for another day, of one digital currency over another. And this whole flow of moving and shuttling digital assets between pools of liquidity for institutional payments, for the funding of transactions, is really only possible if the transfer of that digital asset is extremely efficient. If it takes 4 hours, which is the case in Bitcoin, to move a Bitcoin from one account to another account, or in the case of Ethereum, it takes anywhere from 15 minutes to an hour. It's very unpredictable. It's very difficult to build hedging contracts, to price in risk, for market makers to lock in their quotes. By contrast, XRP, no surprise, is, we would argue, the only enterprise-grade stack today for this exact use case. It's not for a retail use case. Maybe Ethereum and Bitcoin have their own retail use case, but the XRP ledger is closing in 3 seconds. Its throughput is significantly higher than Bitcoin. Bitcoin is falling over around 7 transactions a second. MasterCard's up at 50,000. Ethereum is really not all that much better. And so you really have to think about the stack of that digital currency and that digital asset for this enterprise use case. But a more technical conversation probably for another day.
Sure.
It's a bit of a tangential question, but maybe we can just speculate here. We've seen the rise of Bitcoin. I think it's at 4,700 now or something. Could you speculate, the panel speculate, as to why the Bitcoin price of Bitcoin has gone up so high? And could you also speculate as to whether we continue to see that momentum going into the future?
I got this. I'm just kidding. I have no idea. Anybody's guess. I mean, yeah.
You have Bitcoins?
I mean, so we really don't care about the Bitcoin price because we use it more from a utility perspective. But it's surprising that given all the regulatory issues in China and different parts of the world, that the price has been going up. On the other hand, so there's a correlation, there seems to be a correlation between the price and volume. And volume has been going up, partly for speculation, partly because there's been other jurisdictions where the environment has been more legal, which apparently caused more volume to happen. But who knows? I mean, it's a fairly, the environment's in flux, and it's hard to figure out what actually is going to happen to the price and to the future of it. But we don't care.
I think there are multiple ones. One is, I think, the 2 hard forks coming up. It's increasing demand. Second is there's speculation in the market that Google and Amazon will accept Bitcoin going forward. There are still in the ICO world token being issued that you have to pay by using Bitcoin or Ether. So there's a constant demand for that, because if you issue a token for getting some services, you exchange that for Bitcoin and Ether. So there's a demand going forward. So there are different reasons why you see the Bitcoin in the last 2 months, since it was September was $3,000, we are far over 5,000. That this is now coming up, and now I think this will swing. And the $6,000 is not the end.
So my best attempt at explaining what's going on is to take a hope and pray approach as it comes to cryptocurrency investors. Most cryptocurrency investors are betting on digital assets in that they will have a use case, and that the world will be transformed by digital assets, and that as big macro environment, like big macro changes happen, like China suddenly becomes pro-digital currencies, regulations open in Vietnam, Japan, Russia, it is more and more promising. However, when you really boil things down, you really have to get back to the fundamentals. What will drive institutional demand or significant demand for these digital currencies? Because everybody is basically betting that if I buy it, some other bigger player, some other bigger industry is going to get involved and create more demand such that they'll be able to buy my supply. Bitcoin, question mark. Ethereum, smart contracts, machines paying machines, feels very far away. XRP has a very explicit use case, $10 trillion trapped in Nostro and treasury accounts all over the world that could be streamlined and processed through a digital currency. So, ultimately I think that you're going to see wild volatility until the market lands on some actual use case. And I think that's partly why you've seen a little bit less volatility on XRP, but it's a wizard's game.
I've got one more question of my own since he opened the door to talking about. Well, I'll let him go and then I'll jump on.
Thank you. This is a question to Veeam and XVIA, because you mentioned that this is a solution for business-to-business payments. And you also mentioned that XRP has the enterprise grade for handling the performance. So what are the reasons that you're not opening to the individuals or the end consumers?
To individual transactions? To consumer, you mean? It's really a regulatory issue more than anything else. Regulatory/bank partners we deal with. We set up the environment for business transactions because in the eye of the regulator and the bank partners we work with, they tend to be safer transactions than consumer. So if you, in the money movement world, there's like 4 quadrants of money, like consumer to consumer, consumer to business to business, and the other way around. Typically, business to business is sort of the safer in all these markets. And because we're international, because we're using blockchain, we tend to be high risk anyway. And so if you do consumer, you're like above you go up a notch. So by doing businesses takes it down. That's basically it. That's it. And it's a bigger market anyway.
Well, I wanted to say, since you said you didn't care about the price of Bitcoin a minute ago because you just use digital assets for transmission, I'd like to talk about the relationship between the ability to use these for purposes of on-demand liquidity and so on, which, Patrick, you've kind of talked about how groundbreaking that could be, but the relation between the ability to use them for that and the price that they have to have. Because like a few months ago, I spoke with Miguel Villas, the head of XRP markets at Ripple. XRP is Ripple's cryptocurrency that we've been talking about. And he said, before he could even really have that conversation with banks to encourage them to use this as an on-demand liquidity tool, the market cap needed to be much higher, the transaction volume needed to be much higher, and there needed to be more exchange partners. So if it's just being used kind of for transmission like that, what does that imply about the price versus some of the kind of the retail use case or speculative use cases that
Price is going to go up. No, look,
and how far away
the
is
honest,
some of that?
the honest answer is I don't know Bitcoin and Ethereum. I don't know what the driver of value is there. I think, in fact, when you look at Bitcoin, the initial adoption of Bitcoin is all about retail, and that didn't pan out. And suddenly you have millions of people who hold it. They're just going to hold it. So what's become the use case for Bitcoin is just a store of value, and I think that will persist. And somehow they landed on that, and that's maybe going to persist into the future. But XRP, it's really about this very fundamental driver of demand. Yeah, I mean, if XRP is going to be inserted deeply into the financial system, the market cap has to be orders of magnitude bigger. It has to be able to support institutional flows in the orders of magnitude of trillions of dollars. Today it's a lot smaller. I think it's right around $30 billion. But when you look at
the market cap, I thought, or are you talking about the transaction volume?
The market cap of so there's 100 billion XRP, and the market cap it's trading around 30 cents, so it's about $30 billion. Okay. So yeah, I mean, I think that the current users and sort of the crawl, walk, run of growing the capital market, if you will, around XRP is going to be about fundamental demand, and that comes from companies like Veeam and as more companies like Veeam start to use XRP and use digital currencies in their funding flows, they're going to be putting a massive amount of pressure on banks and larger financial institutions to start using this as well, or they're going to be toast. They're not going to be able to compete and be as nimble as a company like Veeam, who doesn't have to operate with any treasury overhead and all the cost complications that are currently a core part of running a global payments business.
Absolutely. And to prepare for that, you have to start now. And that's for me the key message is the market is changing, the market infrastructure, the rules are changing, and I think you have to embrace the technology to prepare yourself for that tipping point. And the tipping point can be a little bit out there, but if that happens, if you're not in position to respond to that, that has a significant impact on your own market position.
Yeah. Okay, well, I'd like you to thank the panelists for being here today, and hope you enjoyed it.
Thank you very much to Brian, Oliver, Patrick, Marwan. Thanks so much. One more hand for our panel before they go. Oh, we're going to get a picture. So as they're getting their picture taken, I am the last thing standing between you guys and a good glass of wine, so I will keep it close. I do want to do a quick wrap-up of the day. What a fascinating day for the first day of Swell. We went from Dr. Bernanke, who gave us a first-hand insight into how we navigate a financial crisis, kind of a once-in-a-generation financial crisis. We heard from corporates and their pain points and what they'd like to see from banks. We heard from banks and how they're leaning in. And just now, we heard from some of the top thinkers around digital assets and how that all is going to evolve and how that's going to fit in to the whole global payments infrastructure. So we're thrilled about the first day. We were so happy you joined us, but the fun's not over yet. So without further ado, I'm going to invite back up to the stage our CEO, Brad Garlinghouse. And while he's coming up, I hear we're going to be passing around some libations, maybe?
Apparently they thought the only way I would be entertaining enough is to get everyone a little loose here. Let's see.
Well, I don't know if that's going to work, but look over your shoulder, and here's Brad.
So I truly am the last thing standing between you and some entertainment, which includes a toast. Look, today has been a great honor for us to host. It has been, I think, a fabulous inaugural day. There's no question about that. As Eric said, I think we're lucky to have some of the amazing minds and amazing speakers up here. I certainly learned some things today, which is great. But as this is handed out, what I'm introducing now is, I think, a very special guest, a very different guest than some of our earlier, more payments and banking-focused guests. But just as a quick show of hands, how many people here have watched Top Chef or something like that? All right, so, a highly entertaining show. By the time we are done tonight, you are going to be begging for this sommelier to have his own wine show. The entertainment value will be that high. All right, so with that, I would like to introduce you to a gentleman named Paul Greco. Paul is a 2-time James Beard Award winner as a sommelier. He truly is on the global stage one of the leading sommeliers. He happens to be from Toronto, and so he was nice enough to grace us with some time tonight. The thing that I find as a commonality between Paul and Ripple, and I didn't have to stretch very far for this one, because as you will find, Paul has his own irreverent streak of trying to look at the world a little bit differently and making what sometimes is a stuffy pastime in wine something very approachable and interesting. I think the rest of the night you will only hear it referred to as grape juice. But if you would please join me in welcoming Paul Greco.